Okay, this is our final portion of Chapter 11 slides. All right, so we have hinted a few times that there's some things that are included in income, but they're deferred, right? So they're going to be taxed, but only later. So Chapter 11, we finally talk about a couple of those. One of them is Section 1031, non-recognition transactions. These are called like-kind exchanges, or people will just say 1031. All right, where basically you get to trade one property for another, and even though that's a realization event, you don't have to recognize the gain until later. These basically only apply now. You used to be able to trade all kinds of property. It got simpler, at least for you, in that now you can, this only counts on real estate. But what counts within real estate is pretty broad. It just has to, right, on either end, it has to be either trade or business or investment property, traded for business or investment property. It has to happen within a certain period of time. All right, I have a link here to a funny clip. I don't want to try to record YouTube within YouTube, so I'll leave it in your slide. You can click on that. All right, so any real property used in a trade or business is considered like kind with other real property used in a trade or business or held for investment. All right, so I could trade investment property for business property, business for business, business for investment, investment for investment, pretty broad. All right, so that's what counts. So anything else doesn't count. If it's any kind of personal property, doesn't count. Also, even with real property, you can't trade domestic U.S. property for property in a foreign country, right? Any property used in a foreign country, basically, right, is going to be ineligible. It's a tax benefit. Congress is just trying to give it to help our own country. So which of these would qualify for 1031 treatment potentially? If I traded a computer for an office desk? No. All right, this is easy now that they limited it to real estate, right? So inventory, never counted. Land held in it for investment for an office building, right? That would be a trade that I can do and defer any gain. Stock, never counted. That would be too good to be true. There used to be specific categories of animals, doesn't count anymore. A parking lot in downtown Austin for land held for investment in New York, that would count. Land in Iowa for land in Florence, Italy, doesn't count, right, because of it's foreign property. All right, the timing requirements exist because, right, the reason we don't trade most of the time is because it's hard to find somebody who has what you want, who wants what you have. So intermediaries exist for people looking to do 1031 exchanges, right? You basically trade your property to a dealer and they find you other property from somebody else who's traded in. So to get deferral of your gain, you just have to identify the property that you're going to receive in return within 45 days of giving up your property, and you have to actually receive the new property within 180 days. All right, so you can see, right, you can give your property to a third party, they'll find somebody else who wants it, and they'll find other property to give to you. So what are the tax consequences? That's what we care about, right? Basically, right, if I trade my property for something that's worth more than my basis, I have a gain. But if I get like-kind treatment, then I don't have to recognize the gain until I sell the new property, right? But I don't have, right, I can hold it as long as I want. All right, so you get to defer any gain and any loss, but you keep your basis basically in the original property, right? If it's solely a property for like-kind property change, right? So basically, let's say I have a gain and I trade, my gain sort of stays built in so that I will recognize it if I sell it. All right, so suppose I own a commercial building. It's worth 60,000. My adjusted basis in it is 23,000. I want to exchange it for a grain silo that's worth 71,000. Its owner's basis in it is 47,000. Right? So these would count as like-kind property. So if I exchanged them, you can see each party is keeping their basis that they had and getting the new property, right? So now I have a building worth 71,000 and my basis is still 23,000. All right, so I had a gain. My basis was 23,000 and I exchanged that property for something worth 71. So I have actually had a gain, but it's not recognized. It's just built in now. So if I sold this property, I'll recognize the gain. So let's consider another example. Messy Mats trades an old building for a new building. The old building has an adjusted basis of 60,000. It's worth 100,000. The new building is also worth 100,000. All right, so what's going to be the effect? I'm getting something worth 100,000. That's my amount realized. My basis is 60,000, so I have a realized gain of 40,000. But it's a like-kind exchange, so the question is, what's my recognized gain? Since I've satisfied the like-kind exchange requirements, I have $0 of recognized gain. Since this is a simple like-kind for like-kind exchange, I already know my basis is still going to be 60,000, right? But it's helpful to remember the technical formula that I use is going to be the fair market value of the new property. I'm going to add any loss if I postponed a loss, and I'm going to subtract any gain that I've postponed. All right, so since I had a gain realized of 40,000, but I got to defer it, I'll subtract that from the fair market value of the new property. That gives me my new basis of 60,000. Right, what I'm doing, right, by subtracting that gain, I'm building the gain into the new property, at least from a tax perspective. Right, but often, right, it might be hard to make a deal work with a pure property for property of like kind, right, because they might not be worth the same value. So there could be other property that's not like kind property, even cash involved, and we call that boot. Don't ask me why, but it's fun. All right, so when there's like kind property and boot, aka non-like kind property involved, we will recognize some of the gain. We're going to recognize the lesser of, the realized gain or the boot, right? Whichever one is smaller. It's kind of intuitive, right? And then since part of the gain is still deferred, I'm going to subtract that gain from the fair market value of the new property to get my basis. Right? With a loss, I would add the postponed loss. Holding period matters, right, to determine short-term, long-term. So any boot I receive begins on the date of the exchange, but any like-kind property has the same holding period as my old property. All right, so now let's suppose Messy Mats is trading their building again. Their old building is still worth 100,000, basis 60,000, but the new building's only worth 75,000. So the other party also gives them $25,000 in cash to make the transaction work. Right, so now they have like-kind property, a building, but they also have boot, cash. So they still have right, so the total fair market value of the property they receive, 75 plus 25 is 100,000, minus their adjusted basis, they still have a realized gain of 40,000. Now their recognized gain is going to be the lesser of the realized gain or the boot. Well, the boot is 25,000, right? So that's their gain. It's it makes sense, right? They're recognizing a gain to the extent that they got cash, right? So it's a partial recognition. All right, so there's 15,000 40 minus 25 of the gain that they haven't recognized yet, that 15 has to be built in. So it's going to be subtracted from the fair market value to give their new basis, right? Which is, as it often turns out, they're just simply their carryover basis. All right, if I have a loss realized on a like-kind exchange, I don't recognize the loss, even if there's boot involved. Right, that's the flip side. The deferral of the gain is really nice, but people would rather recognize their loss sooner, but they can't on a like-kind exchange. Right, for example, if Messy Mats had exchanged their building with a basis of 60,000 for a piece of land worth 50,000, they would realize a $10,000 loss, but they can't recognize it until if and when they sell the land. Their basis in the land in that case, right, we flip the sign. Since it was a loss that gets deferred, they're going to add that loss to the market value of the land, and they're going to have a basis of $60,000, right, which is the same as their basis in the old building. Another non-recognition transaction would be an involuntary conversion. So this would mean, all right, let's say your property is destroyed in an accident, right, a robbery, or something like that, right? So insurance gives you money, right, which you're probably just going to use to replace the asset. So it would be unfair if you just had to take that insurance money and take a chunk of it to pay taxes when you still have to buy the new asset. So these involuntary conversions are basically treated like a like-kind exchange, where you can defer any gain or loss. All right, you're going to keep your basis from the old property. Let's say you're getting money from insurance and you're using it to replace, right? If you don't use all of the money to buy replacement property, whatever you don't reinvest in the replacement property, you're going to have gain to the extent of that money. Right, the replacement property has to be the same, right? It has to be a similar or related type and use, right? And they're pretty strict about defining those categories of assets, right? I can't just trade it for any other business asset. It has to be basically the same thing. Okay, our other example we'll do of when I can defer income into the future is on an installment sale. An installment sale means I sell something now, but the buyer pays me in payments over time. Pretty common. All right, so we're going to recognize then that gain also a little bit over time. So each time they pay me, I'm going to use a formula to say the percentage of that payment that is income is going to be the gross profit from the sale, right, which is basically your gain amount realized minus basis, divided by the price, right? So whatever percent, that's going to give you a percentage. That's the percentage of each payment that is recognized as income. You can't use this installment sale treatment on inventory, marketable securities, or that would be too easy for people to defer their investment or business income. And also, if, all right, all of the depreciation recapture that we've been talking about, right, where we have to take part of our gain and turn it into ordinary income, you still have to do that. You do that first, and only anything that's left after that can receive installment treatment. The recapture still happens immediately. Right, and if you have an installment sale where you realize a loss, you can realize the loss currently. It doesn't have to be recognized over time. So suppose Georgia sells a truck she used in her business to Tex for $40,000. She bought the truck for $35,000, and its adjusted basis at the time of sale is $25,000. Tex will pay her $10,000 each year for 4 years, right, 40,000 total. So in the first year or each year when she gets her $10,000 payment, how much of that is income that year? Our first thing, right, our amount realized is 40,000, right? Even though she doesn't get 40,000 cash, she's gotten the promise to pay, right? She's gotten a note, right, which counts towards amount realized. The adjusted basis we're told is 25,000. So the gain realized is 15,000, right? But we can see, we know this now, she sold it for 5,000 more than it was worth, right? Cost compared to the amount realized. But her gain is bigger because there's been depreciation. We can tell from the initial basis to the adjusted basis, we know there's been $10,000 of depreciation taken. So 10,000 of this gain has to be recaptured immediately. Right, that becomes ordinary income. Now there's only $5,000 left, right, which we would call a 1231 gain. That's what we're going to use on what hasn't been recognized already, that 5,000. We're going to divide that 5,000, right? We'll call it gross profit. We also have been calling it a gain. Divided by the contract price, 40,000, gives us a percentage of 12.5 gross profit percentage. So that means 12.5% of each payment is income. So when she gets her first $10,000 payment times 12.5%, 1,250 of that gain is recognized. Right? The rest is going to be a return of capital. But remember, in year one, she has already recognized 10,000 of ordinary income from the recapture. So in year one, she'll have 11,250. In year two, another 1,250, and 3 and 4. Another thing where we're not going to recognize something even though it's realized is losses on sales to related persons. Right? There's too much tax planning shenanigans that can happen. So Congress said you just can't recognize those losses. Right? Because if it's a related party, then it's easy for me. All right, there's a lot more incentives and ability for me to sell something at a low price just so I get a tax loss. But that's not going to be allowed, right? If it's happening between unrelated parties in the market, we assume there's a market reason. Between related parties, right, we're always more skeptical. So that's defined to be certain family members, related corporations and shareholders, other entities. Right? So if you sell something at a loss to them, you simply can't deduct it. If they then in the future sell it to someone else who's not a related party, they can use that loss that was disallowed to reduce their gain if they sell it at a gain. And in the future to an unrelated person. All right, so that's chapter 11. We're getting there. We'll put up some practice problems as well, especially for chapter 11 and 7, because the practice really helps on those. The homework should help also.